Lay it on me here. What is the first company that's going to go out of business due to these drill cuts?
Hard to know exactly who the first one will be, but Hercules sort of came out last week with not the best news. They had to announce that one of their biggest customers, Saudi Aramco, canceled a contract for its second most highest rate rig, so one of its best rigs in the fleet, canceled the rig contract for that, and then later an analyst downgraded his estimate on Hercules to sell with a price target of 0. So, you know, saying bankruptcy is not a foregone conclusion, but at the same time, you know, things are looking bleak out there for Hercules and then for the rest of the rig contractors as well. You know, a lot of them have been building rigs over the last few years. It takes about 3 years to build a brand new rig, and they were chasing the market back when it was really good, and now you're ending up with a glut of these new expensive rigs at a time when demand is falling back.
You know, David, we just showed a chart, a one-year chart of Hercules offshore, and it's seen a 90% decline just in the last year, which begs the question, it's not just about the last 6 months of lower oil prices. The company must have already been struggling before that.
The company and certainly the rest of its peers as well. This has been a problem for the rig contractors that dates back even before really the fall of oil prices, which started in June of last year. Their customers, the exploration and production companies, have been pushing back on the rig contractors to bring their prices down. The cost to go out and drill an offshore rig, roughly about 50% of that cost is just the rig itself. Costs about maybe $1 million a day to drill a well, and half that cost, about $500,000 a day in deep water, has been for the rig. And so the customers have been saying, listen, these costs for offshore development have just been getting more and more expensive, and we can't make our money back from the oil that we're drilling in some cases. And so they've really been pushing back on the rig contractors to bring the prices down. And so that's at a time when they're building brand new rigs, and they need to get as much for these brand new rigs that they've been building.
And we're already seeing a merger between Halliburton and Baker Hughes, two of the biggest oil services. Do you expect to see, when you talk to your sources, more of this kind of consolidation continuing?
Yes, definitely, especially within the rig contractor industry, yeah. You know, maybe just picking off 1 or 2 rigs as they're coming off the shipyard line. And a lot of the investors who have been building brand new rigs and adding to this glut out there in the marketplace are people who have not even ever operated an offshore rig before, so they're sort of speculators just trying to build a rig and hope to sell it to somebody. So you're going to end up with a lot more rigs that will probably be priced at a cheaper price available for pickup by some of these rig contractors, but you could also see some consolidation as well.
Yeah, ooh, just make a rig, see what happens. It doesn't sound like a good business plan. Okay, we focus a lot, of course, about shale, and that's onshore drillers in terms of fracking, but where is the loss really being felt? Is it with these shale drillers, or is it elsewhere in the community?
I mean, certainly the shale drillers are feeling the impact, you know, but I would say even more so offshore is where the biggest pain is being felt for the longest. It's sort of a slower moving kind of deal in offshore, because you have to sanction projects way in advance, and you have to sign contracts, and these contracts last for a really long time. And so you're still waiting for some of these more expensive contracts to end, and then their customers are ordering a cheaper contract. And so that sort of delays the recovery for the offshore rig guys. The shale guys can at least sort of turn on a dime, and on shore they can drop rigs and sort of turn things off a lot quicker.
And then real quick, let's just talk about the leverage here. I mean, Hercules, you know, shallow water player, a totally different league than, say, a Transocean, but how levered are these companies?
Yeah, that's going to be the question going forward, is just being able to, for Hercules, one analyst was telling me, it's just a challenge just to pay the interest over the next 12 months, probably, cash crunch there. And so certainly some of these guys are pretty levered, and they're looking for ways to just weather it over the next 12 months, probably. Different possibilities exist. You know, you could sell some rigs, although you're just not going to get a lot for them, because there's just not a lot of demand for these rigs. You could put out a little bit more equity. That may be hard for Hercules with their stock down so much. But right now, Hercules can tap into its revolver. So, you know, there's some chances there in the short term.
Yeah, until those banks reevaluate what their loan is actually worth. All right, I love talking oil nerdiness on a Monday at 8:30. Thanks so much, Bloomberg News reporter David Wethy over in Houston. Thanks a lot.